Welcome to another episode of Focus in Finance. I am Shirley Luu, your host for the day. Right before I got on the interview here, it's kind of interesting because someone kind of said to me, I do have a retirement plan, but I don't need it. I don't need to technically touch it. I don't need to use it. I have plenty of money. My retirement plan, I plan to basically give it to my family, which is very honorable, by the way, very honorable. But I kind of said to them, well, I know you don't need to touch it, but you will have to touch it because your uncle is going to come looking for you if you don't touch it. And when he comes looking for you, he is going to hit you with 50% penalty. On top of that, if you're at a 30% tax bracket, you add 30% on top of that. So whatever money, that you're supposed to take, RMD, requirement minimum distribution, you will be paying 80%. Think about this. If you're supposed to take $10,000 out and you did not, it's okay. You don't have to. You just pay me, Uncle Sam, $8,000. You get $2,000. Did you guys know that is the rules of requirement minimum distribution? So guess what happened? Oh my gosh, this person brilliantly came up. I know how to get out of that I don't have to pay that 80%. I'm in the industry. How to get out of that? The only way you can get out of that is not quite get out, but I'll show you how to get out of it. But anyway, so I said, well, okay, so how do you get out not paying the 80%? Because, you guys know, I always want to know, right? I'm always in the learning mode. And they said, I'll put it in a trust. That's it. I'll put in a trust and I don't have to meet my RMD. Ladies and gentlemen, read my lip. Your uncle is going to find you even if you put in that trust. Requirement minimum distribution, I can put my IRA and forward those things into a trust. Yes, you can do it all day long. No one's stopping you from doing that. But what happens, because that account was previously set up as your retirement from working or other contribution that you get a pre-tax saving from Uncle Sam, when it's time, they want to have their portion. You understand? They want their money. Even if it's sitting in a trust, you have to take that out of the portion that you owe them. Just the portion that you owed your RMD at that time. Now, your question to me, well, Shirley, how much do I owe? Well, it depends. Every one of you out there are different ages. At the same time when you invest, at the same time how much money you have in there. So there's a mathematical calculation that they figure out of how much that distribution needs to be. Now, your current financial firm that whoever you're working with will be able to sit there and explain to you, this is how much it is at least required for you to do, and that's how you can do it, okay? So I just want to make sure that you guys understand that that portion, you do have to take it, you don't have a choice. Now, let's talk a little bit about when you guys said to me, well, what if I don't want it and I don't have to take it? And what if I don't want to have to pay taxes on it as well? So can we talk about right now how that works? Okay. If you go to work for an employer, they either match your money, they didn't match your money, or you get free pension plan, whatever. Doesn't matter whatever plan you have out there. If it's coded under the retirement account, basically somebody gave you some kind of pre-tax ahead, including pension plan. Believe it or not, pension plan works in a way where if you work for a company, I like you, I as a company will pay for that pension plan, where you may not have to contribute. By the way, state, local government, a lot of time may have pension plan. And also if you happen to be a teacher, some school district provide what's called pension plan. But the rules of pension plan are very kind of somewhat strict a little bit. You don't get the pension plan until you retire or leave. Or some pension plan that, no, you don't touch it until you reach a certain age, even if you leave me. So again, all those kind of different, but regardless whether it's pension plan or unless it's a 401k, IRA, if for some reason that you're fortunate enough and said, you know what, Shirley, two things. I don't want to take requirement minimum distribution, and I don't want to pay taxes later on that. So here's how you get around that. You ready? There's a thing called the Roth conversion. So if you've got $500,000 in a 401k, and you already know ahead right now that Uncle Sam is going to go after you for taxes anyway, and that $500,000 you have in that plan right now, you're hoping that with the stock market and things like that, it could be grown to $1 million. So my question for you is that, okay, if you got $500,000 and I help you grow to $1 million, or whoever other financial advisor out there, would you like that $1 million to be tax-free? Now, I don't have to see you out there, but I can say, of course, everyone's tax-free. So this is how you get it tax-free. You ready? Show you the trick. So $500,000 401k, what you do is you can move it into a Roth conversion, ROTH. And let me tell you, because if taxes are currently at the lowest right now, guys, you can, convert it while it's lowest. Because I believe down the future taxes can go higher, because you got all these baby boomers and you got this situation that's happening economically. The government may need money, so therefore they can raise taxes. So if you want to safeguard and say, okay, you know what, let's do the Roth conversion. So your $100,000, what happens is that because you got pre-tax money from Uncle Sam, your uncle is going to want his money. And if you don't have the money to pay all the taxes right now, I encourage you to do a partial Roth conversion. So here's how you do it. On $500,000, let's say you could avert $100,000 of it per year. So this year you take $100,000, convert to a Roth, and that's where the taxable portion comes in. The IRS said, okay, you convert $100,000, I'll let you move it. You can still keep a qualified plan, okay? Because if you keep the same qualified plan, if you're converting it and you're under 59.5, you don't have the 10% penalty. Isn't that cool? The reason I say that, some of you got maybe 50 years old out there and you got $500,000, take $100,000, convert to a Roth. You don't get the 10% penalty hit because you're still keeping it as a retirement plan. However, you do have to pay the taxes. Let me repeat, you have to pay your taxes. Now, when you do this Roth conversion, the firm that you're doing that Roth conversion is going to ask you, do you want me to withhold 20% of it for taxes, or are you going to pay the taxes yourself? It's a matter of choice. Some of my client wants to go ahead and say, oh, take that money out so I can, don't have to worry about it, remember about it. And the other one say, no, I want to pay for it because I've got business, I've got other stuff that I can incorporate that in, as income. Anyway, so with that being said, so you do the Roth conversion at that time, you pay your taxes. Now you get a portfolio, $400,000 in a regular one and $100,000 in a Roth. Next year, you convert another $100,000. Now you've got $200,000 into a Roth and $300,000 in regular. So you're doing what's called a partial conversion so that it doesn't hit you as hard because you get money a little bit over the year and hopefully you make some income that can be offsetting that particular things. One thing about the Roth conversions, once you convert it, guess what? When I turn 73 or 74, 75, I don't have to take that distribution because that now my money is considered after tax money and things like that, and I don't have to take any distribution if I choose not to. Now my family can still get the benefit when I die, under this new IRA Roth that I have. It's pretty cool, Or you can take that money that I converted and create a stream of income, where it can now give you a stream of income tax-free. Now, how cool is that? After 5 years, that Roth conversion is it is tax-free 100%. So that $500,000 over the years, it grew to be $1 million, it grew to be $2 million. I don't care what it grows to. All the gains inside of that conversion is growing compounded interest, it's growing tax deferred, and it's 100% tax-free that you take it out. It is 100% tax-free distribution to your family. Now there's one catch. Actually, there's two catch. Remember I told you that you have to pay the taxes to Uncle Sam? That was the first catch. You can't get away from that, okay? But the second catch is that at the time of my conversion, let's say the first year when you took that conversion, 100,000, in order to be tax advantage, tax free, that on that conversion gains and all that in the future for that 100,000, you had to wait 5 years, because the Roth require 5 years in order to become tax advantages, tax free. The second year, remember when you convert that second 100,000, that is also when the time the clock starts on that conversion of that $100,000 from that time for the next 5 years. You understand? So don't say, oh, Shirley Luu told me my old $500,000 all conversion tax free at the same time. No. If you do it increments, that increments go slowly, okay? Not all one time. Now, if you have the money and pay all one time, heck yeah. You know, if you convert all $500,000 today and pay the taxes to Uncle Sam today, after 5 years, that whole $100,000 you have access to it tax free. But it's a beautiful way of, you know, being able to do conversion, those kind of things. I don't know, you know, I think it's kind of cool, because if you did do partial conversion, it allows you accessibility, even that $100,000, you know, after 5 years, that you could access that money tax free. It's not bad, guys. And then next year, okay, so I get another 100,000 that I can have access to that are tax free. So, you know, again, it depends, you know, your pocketbook, depends what you have. I highly recommend, you know, talk. Look, you can reach my team and I anytime. Shirley Luu. You can Google my name, Shirley Luu and Associates. We operate in 50 states. My office is in McLean, Virginia. You can reach us at 703-608-1203 or ShirleyLouAssociates.com. Again, Lou is L-U-U, okay? And with that, you know, we give you free financial analysis. We give you free financial advice. We give you free guidance. So I would encourage you to take a look where you are, whether you have retirement, life insurance, you know, 401k, IRA, TSP, it doesn't matter. We're there to help you, including long-term care. Again, I love helping people because I've always believed in this motto: we rise by uplifting others. So until next time, I'll see you. Shirley Luu.